Hey everyone, welcome back to Ray CRE Broker, and I'm Ray. If you own or are thinking about investing in retail strip centers, you're probably wondering what is going on in the market right now. The economy is constantly shifting and evolving, and consumer behavior is changing as well. And what may have worked even just 18 months ago might not be what's working now. So in this video, I want to share with you what I'm seeing in the market across leasing, tenant trends, construction, investment sales, and talk about what's performing, what's softening, and where the opportunities may lie for owners and investors in 2025. Okay, so let's start with demand. In Q1 of this year, we actually saw something we haven't seen since 2020. Negative net absorption. That just means more space went dark than got leased. Now, most of that came from big closures. Think Joann, Rite Aid, Forever 21. That pushed total move-outs to over 100 million square feet. And that sounds crazy, right? But here's what most people don't realize. Even with all that, vacancy only ticked up to 4.3% nationally. That's still near historic lows. And that's because spaces are getting released pretty quickly, especially if you're in a growing suburban market and have a decent tenant mix. The inventory that's moving, it's mostly small space, under 5,000 square feet. Think quick service restaurants, medtail, that's medical retail, boutique fitness, nail salons, barbershops, service-based daily needs types of retail. That's what consumers are still spending on. Now let's talk about supply. There's just not a lot of new retail being built right now. Since 2020, we've averaged only 81 million square feet of new deliveries per year. That's 73% below the early 2000s average. And when you factor in demolitions, we've lost over 165 million square feet of obsolete product. You've got a net reduction in inventory. That's why vacancy has held so low, and it's why rents are holding up even if demand is softening in certain pockets. There's very little first-generation space out there. About 40% of all retail listings on the market right now, according to CoStar, are 2-star or lower. In other words, older space that might need some work. So if you've got clean, well-located space, you probably have some leverage. Speaking of leverage, let's talk about rent growth. Yes, rent growth has slowed. We're sitting at around 1.9% year over year nationally. That's a cool down from the 4 to 5% spikes we saw after COVID. But here's the key. Rents are still growing. And if you're in a market with strong population and income growth, like parts of Texas, the Carolinas, or Arizona, you're still seeing very healthy rent bumps. Tenants are becoming more efficient too. They're doing more with less space. That keeps occupancy strong and it pushes up sales per square foot. That gives landlords more pricing power on renewals and extensions. Now looking at sales, the investment market for strip centers is actually rebounding. Sales volume is up about 11% year over year, and April was up 45% from the year before. Cap rates have flattened out. They're not blowing out anymore like they did in 2023. Right now, strong QSR in grocery-anchored centers are still trading in the 5 to 6% cap rate range, and weaker assets, think older strip centers with lots of vacancy or tenant risk, are up above 7 to 8% cap rates. There's definitely a two-tier market happening, especially with the closures of drugstores and dollar chains. But if you got stable leases, below market rents, and a solid location, there are buyers out there. Now, if you're a retail center owner right now, here's what the smart ones are doing. They're reviewing their leases, taking a look at what's expiring in the next 12 to 24 months, asking, are there rent bumps built in, renewal options? They're also reconciling triple nets properly. If you're not billing tenants correctly for CAM and taxes, you're leaving money on the table. They're also looking at repositioning. Can you bring in some type of medtail user? Can you add a drive-through? Maybe upgrade that facade or signage. They're particularly watching return on equity. not just cash flow. You've really got to take a look at your property's worth and net operating income to see if you are overexposed. And some owners are selling. If they've got a stabilized center and hit their goals, we're listing it, while buyer appetite is very, very healthy. So where are we right now? Strip centers in 2025 are still a very bright spot, but you have to be dialed in. Demand is out there, but it's somewhat shifting. Supply is tight, which helps. Rents are holding, and there's still a lot of capital out there looking for solid assets. Thanks for watching, and if you find any of my videos helpful, please like and subscribe, as it will help me in providing better content for you. If you need any help with anything, connect with me on LinkedIn or leave a comment below. Until next time, make more money on your deals.